Welcome to The Explainer. Today, we're going to tear into one of Canada's biggest retail success stories, Dollarama. Using a really detailed value investor analysis, we're going to answer one simple question. Is this stock a smart place for your money right now?
You know, this brings us to a classic trap that so many investors fall into. It's really easy to see a great company, a brand you love, and just assume it's a great stock to buy. But as we're about to see, what you pay for that company is everything. That's the core of what we're digging into today, separating the awesome business from the price of its stock. So, here's our game plan. First, we'll get a handle on what makes Dollarama tick. Then, we're going to crunch the numbers to figure out its real value. After that, we'll weigh its strengths against the risks, look at some possible future scenarios, and wrap it all up with a clear, data-driven verdict. All right, let's jump right in. First things first. What exactly is Dollarama? And how on earth did it become such a monster in Canadian retail? Well, the model is just brilliantly simple. Dollarama is a machine built for high volume and low prices. Think about it. Their whole operation is geared toward one thing: getting stuff onto the shelves and into your shopping basket as fast as humanly possible. And they do this while keeping a razor-tight grip on every single penny of cost. That incredible efficiency is their secret sauce. It's what lets them deliver serious value, and it's why shoppers keep coming back.
Now, look at this number. What's so amazing about it isn't just the number itself, it's the consistency. For 5 straight years, Dollarama has grown its revenue by over 11% annually. I mean, in the world of retail, which can be super competitive and slow-growing, that kind of steady, double-digit growth is it's incredible. It really shows you how powerful their business model is.
Okay, so we've established it's a fantastic business, but now we get to the million-dollar question. What is the stock actually worth? This is where we separate the great company from its price tag. So let's just cut to the chase. Based on all its future potential, all the cash it's expected to make, what does the analysis say the true or intrinsic value of one single share of Dollarama is? Okay, so here's how the math breaks down. Using a discounted cash flow model, which is a fancy way of looking at all the future money a company will likely make and figuring out its value today, the analysis gets to $132 a share. Then, looking at how it's priced compared to similar companies, it gets a value of $150. You blend those two trusted methods together, and you land on a final intrinsic value of about $141 per share. That's the number this analysis says the company's really worth.
And this right here illustrates the core problem perfectly. The analysis pins the company's real value at $141, but the market, at the time, was selling it for $190. You can see the scale is tipped way over. That is a huge gap between what it's worth and what it costs.
So, what does this all mean? Well, according to this analysis, the stock is overvalued by a whopping 35%. And that means there's no margin of safety. Think of it like this. There's no buffer, no cushion for you as an investor if things don't go absolutely perfectly for the company. You're paying a premium price right from the get-go.
Okay, so we see this big valuation problem. Now let's dig a little deeper to understand the why. What are the company's core strengths that might make people pay so much? And what are the real underlying risks? Dollarama has what investors call a strong moat. And no, we're not talking about castles. A moat is a durable competitive advantage that protects it from rivals. For Dollarama, that moat is built from its massive size, which lets it buy goods cheaper than anyone else, its incredibly efficient logistics, a brand name that basically screams value, and the fact that it earns exceptionally high returns on every dollar it reinvests in itself.
So let's put this all on a scale, weighing the good versus the bad. On the plus side, you've got really high-impact positives, like its return on capital and cash flow. But look at the negative column. The one factor with a high weight, the biggest risk of them all, is the same thing we keep coming back to. It's premium valuation. That's the elephant in the room.
In this quote from the analysis, it really just says it all, doesn't it? Bottom line, you have a fantastic business, but the stock itself, the equity, is just too expensive right now.
Okay, so what do we do with all this information? Let's get practical. Let's look at what the future could hold for Dollarama. And more importantly, figure out at what price this stock actually becomes a good investment. Here we've got 3 different possibilities. In a bear case, if growth slows way down, the value drops to $115. The base case, which is the most likely, is our familiar $141. But here's the real kicker. Look at the bull case. Even in the most optimistic scenario,
where growth stays at that incredible 11% rate, the calculated value is still only $170. That's still way below the market price of $190.
All right, now for this analysis to work, we have to set a goal. And the specific objective here is to get at least a 9% annual return compounded over a 16-year period. This specific target is the key that unlocks the right price to pay.
And this is where the discipline of value investing really shines. It's not about feelings or hype, it's just about the math. This table shows you exactly what you can afford to pay today to get the return you want tomorrow. So, to hit that target of a 9% annual return, the analysis is very clear. You cannot pay more than $125 per share.
So, after looking at the business, the valuation, all the risks, and those hard price targets, what's the bottom line? What's the final takeaway from this whole deep dive? You can really boil this entire analysis down to 3 simple steps. Step 1. Acknowledge the quality. Dollarama is an absolutely fantastic company, no doubt about it. Step 2. Highlight the problem. It's just too expensive right now, trading way above its real value. And that leads us logically to step 3, the strategy. Be patient. Wait for the market to give you a better price.
So the final recommendation, the bottom line from this entire analysis, is crystal clear. If you already own the stock, it's a hold. But if you're thinking about buying in, the advice is simple. Do not buy the current price of $190. So there you have it. It's the classic story of a wonderful company trading at a not-so-wonderful price. Now I'd love to hear from you. What companies should we put under the microscope next? Drop your suggestions in the comments below.